Hi, Nicholas from Data Trek Research here, and today's topic is disruptive innovation. This, I think, is one of the most both overused and misunderstood terms in strategic analysis today. And today's discussion is going to be about what I think it is, how I think it works, give you a ton of examples with which to kind of hang some of these concepts off of, and then wrap up with some thoughts about what it means for investing today. So, if you want to understand disruptive innovation, the guy to read is Clayton Christensen, who was a Harvard Business School professor for many years and both coined the term and then wrote books about it and wrote articles about it. The book he wrote back in 1997 was The Innovator's Dilemma and really laid the groundwork for the idea. And it's been used by everybody from major venture capital firms to every big tech CEO for the last 20 plus years. So, a very influential book. If books aren't your thing, I would encourage you to Google "What is Disruptive Innovation" by Christensen. It was an article in 2015 in the Harvard Business Review, and it gives a very nice summary of his thoughts on the topic and how he thinks it works. So, a couple of reading suggestions for you before we kick off. Now, Christensen's model is pretty straightforward. He says disruption occurs with two things. The first is the one we all know. A company comes into an industry or a business with a new idea for how to do things, usually tech enabled in some way, but perhaps just a very big change in business strategy and business focus, and they start off with that disruptive idea. The thing people don't talk about, but is super important, is that the business almost always starts at the low end of a market. So whatever it is that business is, that disruptor comes in at the low end, selling the least expensive good to an underserved community. Now that's important because in every business, there are major companies already involved, right? Those major companies aren't just going to give away their business to somebody new who comes in, no matter how cool their technology is. By coming in at the low end, that new disruptor has a shot because as those incumbents look at the new entrant, they'll say, "We don't care. Let that new business have the low end of the market. We'll retreat up the value chain. We make more money there anyway, and this new company can have the small dribs and drabs at the bottom end of the spectrum." And that's fine over the short term. It improves the returns of those incumbent businesses, but it also gives that new disruptor a real toehold in an industry. And over time, the disruptor moves upscale, moves up the marketplace by adding products and services that fit the bigger part of the market. So they take the same technology and just make it better, make it more useful, add new services, add new products. And over time, they keep chipping away at the incumbent until the incumbent either just adopts the business model of the disruptor or it disappears altogether. And that's the way disruption actually works. There's some good examples of this. So, for example, we all know Amazon started off by selling books and then moved up the value chain, selling more and more things. But you can go back further in time and look at examples like the Japanese car companies in the 60s and the 70s. My old expertise covering the autos at First Boston. The Japanese came into the U.S. market in the 60s selling small, fuel-efficient cars, and the big three at the time said, "We don't care. Let them have the small car business because we make so little money off of that." But over time, the Japanese companies added mid-size cars, then full-size cars, and then luxury cars, and began to take over the market. And the South Korean companies did the same thing about 20 years later. So starting at the low end with small cars, moving up the value chain. Same exact thing as disruption, no real technology required, but the same basic business model. Smartphones started off as a kind of first world developed economy product, but where they became disruptive was when they went into the emerging markets like China and Southeast Asia and Africa, because it gave users a computer-like tool connected to the internet where they could have never afforded a computer because incomes are so low there. So it was disruptive around the world, not because it was sort of started off in the US, although it gained traction here. It's because it disrupted and gave a new product to people who couldn't afford the existing product. A lot of computer companies totally missed that move, and as a result, we now have smartphones ruling the world instead of laptops and PCs. Now, this topic, while it may seem like it just really started to come around in the last 50 years, the same concepts apply even going further back. And I want to share with you one very, very good example of that, and that is the Sears Roebuck catalog. So for those of you who don't know, Sears started in the 1880s, 1890s selling watches by catalog. So mail out a catalog, people buy the watches. But they found that they could sell a lot more things. So by the early 1900s, they sold kind of everything through the catalog, and they could do that for two reasons. The first is railroads finally connected the entire country together, and so you could ship goods all over the country pretty efficiently. The second thing is that most of the U.S. population lived in rural areas in the early 1900s. It wasn't like today where most people live in cities. They lived in countrysides and on farms and in small towns, and their shopping options were super limited. So you could go to the local store and maybe buy one or two men's suits or one or two women's dresses or some kids' clothes or a couple of books, but you couldn't get much more than that. So now imagine you're a farmer in 1920s America, and you get in the mail this. This is a Sears Roebuck catalog from 1920. I collect them, so a little nerdy, but I do. And I find them a fascinating time capsule for the American economy through different points in its history over the last 100 years. And in that now 1,300 page book, you could shop for everything from furnishings to clothes to kids' toys. Anything you wanted was in this book, and an amazing selection. So this competed against the local corner store, and they just couldn't compete because this was so much better. And it must have been absolutely magical when you got this catalog. And I recall hearing from people who were around back then that when the Sears Roebuck catalog came, that was a big day in the household. Now, that's 1920. What's amazing to me is this is a 1932 Sears catalog. And this is the depths of the Great Depression, and still a pretty chunky book. So Sears was able to hold on to its competitive advantage because of its initial toehold in disruption by competing with local stores and competing successfully and gaining and building a business as a result. And this went on for decades. So just as an example, this is the 1969 Sears Roebuck Christmas catalog. This was another big thing that came in to households all through the 40s and 50s. This was all kinds of ideas for Christmas presents for kids, mom and dad, everything. And as a matter of fact, the Sears catalog stayed in business until 1993. That was the last time they published a catalog. And so 100 years of catalogs, and it built a tremendous business. We all know Sears as the company that kind of went away over the last 10 years, but from 1908 to 1972, Sears, the stock, compounded at 16% annually. It's just an amazing rate of return versus the S&P's 10, 11% over the same period. Sears actually built the tallest building in the world in 1973 in Chicago. That's how well off this company was. So it started off as a little thing, just selling some stuff to farmers in a big catalog, blew out into retail stores and all kinds of other products and services that Sears could sell. And so that is a great example of how disruption doesn't require a computer or a smartphone or a piece of clever software. It just involves targeting the low end of a customer of a market, targeting those customers, and then giving them something really worthwhile and doing it over and over and over again, and then moving up the value chain, maybe adding stores or other services. And that's how you build both a successful business and have a winning stock. So let's move on to the last part of today's talk, which is some lessons about what I've just talked about from the perspective of investing and being an investor. So the first and most important thing, again, is disruption starts at the low end of a market. So here's an example you may not think about, but is absolutely valid. Bitcoin. Bitcoin's a $500 billion market cap asset. Why? Because they began life targeting the low end. It began life targeting people that didn't necessarily trust the banking system, didn't trust their local bank, or didn't trust the dollar or their local currency. And they saw Bitcoin as a viable option. It used a new technology called the blockchain to deliver that product. And lo and behold, it took. And it took for the same exact reasons the Sears Roebuck catalog took. It served an underserved consumer with a really clever offering, that's something that was useful. And so now we have Bitcoin being a $500 billion asset, which is amazing. The second thing that's important for investors to understand is that disruptions drive stock returns. We talked about Sears having a fantastic return for almost 60 years when, through depressions, through wars, and it lived through all of it. But it's also valid today in terms of thinking about all the big tech companies in the US stock market, Amazon, Google, Microsoft, Apple, and so forth. They started off as disruptors, just like Sears did, and grew into something really special, just like Sears did. And so their toeholds became massive competitive advantages based on one or two critical products. And that's in essence why indexing works, because indexing doesn't care if the idea sounds smart or dumb, as long as it's big enough to be in the S&P or the NASDAQ or whichever index you care to look at. That index will continue to hold it as long as it works. When something else comes along, it'll hold that. That's why it's so tough, I think, to beat indexes as an investor, professional or individual, simply because disruption happens in very unexpected ways. And so it's very hard to see what's going to be coming down the road. All you know is the market kind of gets it right over time, and you want to be involved. The last point that I think is super important, and this is just for basic asset allocation, if disruption drives long-term returns, and we know it does, then we want to be looking for areas of the world with a lot of disruption. And on that count, the U.S. economy, the U.S. marketplace is head and shoulders above the rest. Whether it be Europe or Asia, developed or emerging economy, the U.S. simply has a deeper, more robust venture capital industry. And that's an incredible competitive advantage for U.S. stocks and for the U.S. stock market. So for example, last year, U.S. venture capital put to work about $225 billion in startups here in this country. The numbers for the rest of the world are less than that. Europe and Asia combined are only $200 billion. So you see that the U.S. economy is generating this venture capital industry in order to fund growth. And it's not just the money, it's all the know-how that venture capitalists can put to work as well. And the beauty part of it is that U.S. equity investors get that whole ecosystem for free. So whatever works in venture capital, we get as public companies. Whatever doesn't work goes away. It didn't cost us a dime. So as with some of our other videos, one of the lessons here is the U.S. capital markets, U.S. stocks have a competitive advantage that's really important based on disruptive innovation that the rest of the world doesn't have as much. So that's the bottom line. Disruptive innovation is super important. Hope you enjoyed this video. As always, please like and subscribe, and check out our website at datatrekresearch.com if you'd like to sign up for a 2-week free trial to our work. So that's it. Have a great day.